Hello and welcome to the spring edition of Haider's Hits, a seasonal video with timely insights to help you use your wealth on purpose. I'm sure by now that you've seen the headlines about the stock market sell-off. We've recently seen that 10% correction with all the talk about tariffs and economic headwinds. Well, it might feel like recession is just around the corner. So today I want to explore the anatomy of a sell-off and how to think about navigating the volatility that comes with investing. And we'll also discuss a few tax planning moves you might consider when investment values dip, so stay tuned. You know, a normal market correction around 10% or more, look, it can feel like a roller coaster ride. You may see your account balances take sudden drops, and the 24-hour news cycle, well, it only amplifies your anxiety with the breaking updates every hour or even every minute. Market dips, well, they can be triggered by many factors, such as rising rates, geopolitical events, or in this case, concerns about new tariffs. While it's never fun to watch your portfolio fluctuate, corrections are a regular feature of healthy markets. So let's talk about the different kind of dips you might see. Well, there's that normal correction, that 10 to 15% drop. These are just speed bumps of investing. And they often happen once or even twice a year as markets recalibrate. You know, even when markets are big, have a big up year, 20% or more, it's very common to see a drop of 14% sometime during the year. But what we're really concerned about a lot of times is that big bear market, the 20% or more. So think of these like a bad storm. They can last longer, they can do more damage, but historically, they've also been followed by recoveries as markets regain their footing. In fact, missing out on the best up days in the market recovery can lead to significantly lower long-term returns. And those up days happen in close proximity to the worst down days like we usually see in bear markets. But let's talk about recessions. Although a market downturn and a recession aren't the same thing, big declines can sometimes coincide with recessions as economic output slows. Yet even in actual recessionary periods, the U.S. economy, it's repeatedly shown resilience over time. Look, I know watching your portfolio dip can be nerve-wracking, like trying to drive through a sudden downpour. Everything inside of you screams, your instincts say, pull over, stop, get out of the way. But with investing, if you have a well-built financial plan, focusing on your destination will often get you safely through that storm. Market declines can even present opportunities to buy quality investments at lower prices or position your portfolio for future growth. Now, market downturns also provide key opportunities for good tax planning moves. Let's take a look at a couple of them. So first, there's a Roth conversion. That's moving money from a traditional IRA asset to a Roth IRA. When you do that, when account values are lower, well, that can potentially reduce your tax bill in the conversion and allow any future recovery or growth to happen tax-free. Another thing to consider is tax loss harvesting. If you hold a taxable investment account, you may consider selling positions that are underwater to capture a tax loss, which can offset future gains or in some cases a portion of your regular income. And that can be a strategic way to reduce your tax liability and rebalance your portfolio. Another thing to consider is gifting. If you regularly gift shares of stock to family or charity, doing so when prices are depressed, it might allow you to give more shares with the same dollar value, potentially providing greater benefits down the road. And of course, there's always portfolio rebalancing. If your stock allocations have fallen more than you'd like, these market dips can be an opportune time to rebalance back to your target mix. Essentially, you've built in a buy low strategy when you bring your portfolio back into alignment. Now, let me give you some final thoughts. Investing has its ups and downs, just like the roads we drive. But with a sturdy plan in place and some thoughtful perspective, you can stay focused on your final destination rather than the jolts and potholes that come along the way. Corrections are normal. Bear markets are tough, but they can be navigated, and recessions, while scary, they don't last forever. But if you're feeling anxious, let's connect. Let's review your financial plan. Remember, a sound plan isn't about predicting every twist and turn. It's about preparing for them so you can keep using your wealth on purpose without letting fear get in the driver's seat. Thanks for joining me today. If you found this helpful, please pass it along to your friends and family. I look forward to sharing more in the next edition of Haider's Hits.